Welcome back. It's time for Earnings Exchange. And today we've got the action, the story, and the trade on Tesla, Las Vegas Sands, and Lam Research, all reporting after the bell, I believe. CNBC contributor Jeff Kilburg is here to give us the key points. He is CEO and founder of KKM Financial. Jeff, welcome. Got to start with Tesla. Shares have still more than doubled so far this year. Deliveries and price changes will be key to watch, and the street isn't too optimistic. B of A cut its estimates, saying on the automaker, while Barclays is expecting, quote, soft results amid times of soft margins. Of course, we want to hear what Musk says on the call. This stock is down 4% today, one of the worst in the S&P. What would you do with it here?
I want to be a buyer here, Kelly. I've been long the name since last December. And yes, the street's looking for 72 cents a share on about $24 billion in revenue. But you're right. We're going to be focused on what that revenue will look like next year in 2024. But right now, you have to look at this either through an automotive lens or an AI lens. And I think when it's trading at 70 times PE, that's pales in comparison to what NVIDIA is trading at, and I like it here as an AI play. I think you can actually approach this right now with the volatility. You can sell a put. You can sell a 245 put right here, collect over $8, Kelly, expiring Friday. So you're getting paid if you want to own Tesla, and I do.
All right. What about Las Vegas Sands? Very different story here. Shares are down more than 30%. Just that since its 2023 highs in early May just tells you how different a tone things have now. Deutsche highlighting the recovery in Macau, also in their mass gaming revenues and hotel occupancy. All of those, they say, will be key factors to watch today. Would you be a buyer of this stock?
I'm not a buy here, and I don't want to be a hard seller here, Kelly, but at the end of the day, we have to see what transpires and what that revenue out of Macau as well as Singapore looks like. But it's dragged the broader market. And if you look at a longer metric in 5 years, not to give you a little Halloween pun here, but it's been a zombie stock. Hasn't gone anywhere in 5 years. So I want to stay away from this. But they do have a strong cash position. They do have a decent balance sheet. So I'm not going to hate on anybody who's long here, but I just don't want to own it.
No, there's the 5-year chart, down 20% really during that time. So it's just been a slog. How about Lam Research? Chip stocks have been under pressure lately, of course, because of those China import controls. But Lam shares, it's more of the designer. They're up 55% so far this year. And those restrictions plus the recovery in memory chips are going to be, things investors are watching after the bell. Would you want exposure here?
I think you can get exposure here. Yes, it's had a great year, but it really correlates. If you look at SOXX, it's outperformed stocks, but at the end of the day, had a rough 2022. But when you talk about some of its biggest clients, Lam Research's biggest clients are Micron, Intel. That's everywhere everyone wants to be positioned. So I think owning the fabricator makes a ton of sense, at least the equipment that provides those chips to be made. So yes, I want to be a buyer here, Kelly. It makes a ton of sense to continue this exposure to semis as this AI theme will recur and revert back to enthusiasm, I believe, Q4 as we go into the Santa Claus rally. I know Santa Claus rally has not been said yet on CNBC today with all the red out there, but I think you want to own this name.
Well, that actually brings me to my next question. I can't resist, especially on a day like this, Jeff. We start with an okay tone to the markets. We sell off sharply. We come back after the bond auction. Yields are popping across the curve. What do you make of it?
Well, Kelly, I cut my teeth in the bond pit. You know that back in the 1990s. And it's just remarkable to see the sensitivity that equity traders are having to the bond market. So we continue to look for the bond market for leadership. We continue to look for the bond market for sensitivity of what's going on in the Middle East. But I do believe we are at peak rates in the 10-year and the 30-year. We saw the mortgage rate hit over 8%. It's the first time it's happened in over 20 years. So I think we're going to see that relent. But my thesis on being long, not just the market, but some of these tech-sensitive names like a Tesla or a Lam Research is on the fact that I see the 10-year going back under 4.5% due to the fact that the Federal Reserve will not raise rates. There's no chance per the CME FedWatch tool that they're going to raise rates in November, just in 14 days, but it also looks like it's a less than 40% chance in December. So I think the Fed has to sit on their hands or they'd be quite ignorant if they didn't.
Yesterday, it felt like it was a classic macro rates trade Fed. Today, I'm not so sure. Today, it just feels like the whole thing's, untethered.
Yeah, it's a roller coaster, and you're seeing exaggeration. You're seeing people still reposition their portfolios, but I think we have to look for bond leadership, specifically at the long end of the curve, and some indication out of the Fed that they understand that they can't move rates much higher here. I know they're not getting the results they want in the data, but they are going to sit on their hands.
All right, Jeff Kilburg, as always, thank you. Like the pumpkins as well, sir.
Ken.
We'll check back in soon.